Keeping your money in a bank seems like a smart idea, right? But there's more to banks than meets the eye. Billionaire Henry Ford once said it's good that most people don't understand banks because if they did, it could cause big problems. One big reason why some people have a lot of money and others don't is because not everyone knows how to manage money well. If you want to be rich, you need to know how to handle your money wisely. Today, I'll share some secrets about banks that only rich people know. We'll talk about how banks make money from you and what you can do to make sure your money stays safe and doesn't end up lining the pockets of greedy bankers. Let's find out together. Back in the 7th century BC, in the thriving city of Babylon, the concept of banking first emerged. These early bankers lent money with interest, marking the birth of banking as we know it. It was during this time that the first banknotes, which were equivalent in value to gold, came into existence. The word bank has its roots in Italy, derived from the word banco, meaning table. Initially, banks primarily facilitated the exchange of large sums of money into smaller denominations, as well as handling coin exchanges and other cash-related transactions. As economies evolved across different regions, banks expanded their services beyond basic cash transactions. The first recognized private bank in the world is believed to have been a group of private individuals from Genoa, who formed the Partnership of St. George in the 12th century. This bank played a significant role in financing the Genoa Republic's war efforts in 1148, in exchange for tax collection rights from citizens. By 1407, the Bank of St. George was formally established, marking a pivotal moment in banking history. Throughout history, people have had mixed feelings about banks. While they provided essential financial services, there was also a perception of bankers as greedy or deceitful individuals. Money lenders were even excluded from religious ceremonies and denied proper burial rights. Even in modern times, distrust towards banks persists, as the complexities of the banking system and its practices can be difficult to understand. It's undeniable that banks hold secrets, even your own bank. So let's delve deeper into these mysteries and uncover more about the inner workings of the banking world. Banks make money from you in sneaky ways. First off, they have something super valuable: your information. They use this to come up with new deals and offers that make them more money. Sometimes they even sell your info to other companies, like ones that give out small loans or even to scammers. It all depends on how trustworthy the bank's employees are. Another way banks cash in on you is through sneaky fees on your credit cards. They might offer you a fancy card with extra perks, but you have to pay a fee for it. Or they can quietly charge you what's called a shadow tax. Basically, every time you use your credit card, you're unknowingly charged a bit extra. You might not notice it because you expect the seller to pay the tax, but they often just raise the prices instead. So in the end, you end up paying the hidden tax without even realizing it. Banks prefer lending money to wealthy individuals for a couple of reasons. Firstly, banks are like any other business. They need to make a profit to stay afloat. So they're more inclined to lend money to someone who's rich because they're more likely to pay it back. If a wealthy person can't repay the loan, they often have valuable assets like a business that they can sell to cover the debt. This makes them less risky for the bank to lend to. Secondly, if the bank itself runs into financial trouble, having wealthy clients who owe them money can be a lifeline. In case the bank faces bankruptcy, they can turn to these wealthy individuals to get loans, helping them stay afloat. In essence, banks give better terms to rich people because they're seen as less risky and more reliable borrowers, which ultimately benefits both parties involved. Banks don't store money. Contrary to what many people think, banks don't just store your money like a piggy bank. When you deposit money into a bank account, it's often promoted as a safe way to earn some extra cash without doing much. But in reality, in many countries, this method isn't very effective because the interest you earn on your deposit is usually lower than the rate of inflation. Let's break it down. Say you put your money in a Swiss bank in 2020. The bank might offer you an interest rate of around 0.5 to 1.5%. But here's the catch. The average inflation rate is higher, around 1.5 to 2%. This means that the interest you earn might not even keep up with the rising prices of goods and services, effectively eating away at your savings. So why do banks offer such low interest rates? Well, it's because they don't really benefit much from just holding on to your money. Instead, they lend it out to other people at higher interest rates, pocketing the difference as profit. This way, they make money while your money works for them. Plus, governments like when banks do this because it keeps money flowing in the economy. Not only does the bank get to use your deposit, but now the government also has a hand in controlling how money moves around. This is why the super rich often look for other ways to protect their wealth, since keeping it in a regular bank account might not be the best option for them. Banks prioritize serving themselves over their customers. When you deposit money into a bank, it becomes the bank's asset. Similarly, when you borrow money from the bank, it remains the bank's asset. This means that banks always prioritize their own interests. They're in a favorable position where they benefit regardless of whether you're depositing or borrowing money. Banks are primarily concerned with maximizing their own profits, rather than advocating for the interests of their customers. Your money, once deposited, essentially becomes the bank's property as well. A bank's lending capacity is directly tied to the amount of deposits it holds, creating an unequal relationship between the bank and its customers. Banks often judge people based on their appearance when deciding whether to give them a loan. Bankers are typically dressed very professionally, and they tend to notice how others look. If someone appears wealthy, the bank is more likely to approve their loan application. Conversely, if someone looks like they need the money, the bank might hesitate to lend to them. One exception to this rule is if someone already has a bank account. In that case, the bank can check their financial history to see if they're truly wealthy. But if someone doesn't have an account, the bank might rely on their appearance to make quick judgments about their financial status. Bankers receive an annual bonus for approving loans. This bonus isn't given to all bank employees, only to those responsible for approving loans. Usually, these are managers, and it's not a bad thing. The size of the bonus depends on how many loans are approved, but they have to be reliable loans. Everyone at the bank wants an extra payout at the end of the year, so they might be more likely to approve loan applications as the year-end approaches, even without realizing it. At the start of the year, managers might not feel pressured to approve loans, but as the end of the year draws near, they might worry about not approving enough applications and missing out on their bonus. Plus, nobody wants to be seen as incompetent, so if a customer doesn't get the loan, the bank employee might miss out on their yearly bonus. This is where wealthy people come in. They have the necessary assets and credibility, so they can request larger loan amounts, maximizing their benefits from the system. Banking fees disproportionately affect low-income individuals. Banks offer different services like checking accounts, where you keep your money safe, and credit cards, which let you buy things without cash. But here's the catch. Sometimes, when you use these services, the bank charges you extra money called fees. Now imagine you don't have much money to begin with. Every time the bank takes a bit of money as a fee, it's like they're taking a big bite out of your small piece of cake. These fees, like when you spend more than you have in your account, called overdraft fees, or just for keeping your account open, maintenance fees, can really add up. For someone who already has a lot of money, these fees might not seem like much. But for someone with less money, these fees can be a big problem. It's like if you only have a few cookies and someone takes a bite out of each one, you end up with even less. So for people who are already struggling to make ends meet, these bank fees make things even harder. It's like trying to walk with someone holding onto your backpack. It slows you down and makes everything more difficult. This makes it tough for them to save money or even just pay for everyday things. And that's why these fees can make the gap between rich and poor even bigger. Predatory lending practices. Imagine you need to borrow some money from a bank to buy a house or a car. Now, there are some banks out there that don't play fair. Instead of helping people like you, they try to take advantage of you, especially if you're already having a tough time with money. These banks might go after people who belong to minority groups or who don't have a good track record with money. They do this because they think these folks won't notice or won't have many other options. So what do these sneaky banks do? They offer loans that seem okay at first, but when you look closer, you realize they come with super high interest rates. It's like buying a $1.10 pizza, but having to pay back $1.20. Not a good deal. These types of loans can end up causing a lot of trouble for people. They might struggle to make the payments every month, which can lead to even more debt and stress. In the worst cases, they might lose their homes or cars because they can't keep up with the payments. It's like getting stuck in quicksand. The more you try to get out, the deeper you sink. So it's really important to be careful when borrowing money from banks. Make sure you understand all the terms and ask questions if something seems fishy. You don't want to get caught in one of these tricky situations. Environmental and social responsibility. Think of banks as big piggy banks where people keep their money safe. Now, some of these banks invest their money in things like oil or guns, which can harm the environment or communities. When you put your money in these banks, you might be supporting these harmful things without even knowing it. It's like accidentally buying a toy made from recycled materials versus one that harms animals to make. But there's good news. Some banks care about things like the environment and treating people fairly. So if you put your money in these banks, it's like supporting good things like planting trees or helping people in need. By choosing a bank that cares about the same things you do, you can make a positive impact with your money. It's like choosing to buy snacks that are good for you and the planet instead of ones that are bad for both. So when picking a bank, think about what matters to you and choose one that matches your values. Manage your finances properly. The insights I've shared today aren't meant to discourage you from using banks altogether. They're simply pointers to consider when it comes to making smart decisions about your money. For example, instead of simply depositing your money into a savings account where it may not grow much, you might explore other options like investing in stocks, bonds, or real estate. By diversifying your investments, you can potentially earn higher returns over time. Similarly, when it comes to using credit cards, it's essential to be mindful of the hidden fees and charges that can add up over time. While credit cards offer convenience, paying with cash for certain purchases can help you avoid these fees and keep more money in your pocket. Plus, paying with cash can also help you stick to a budget and avoid overspending. Being smart with your money is super important for doing well financially. One way to do this is by learning about different ways to invest your money. Instead of just putting it in a regular bank account, you can look into other options like stocks or real estate. This way, your money has a better chance to grow and help you reach your big money goals. Also, it's crucial to keep an eye out for any sneaky fees or charges that banks might try to hit you with. By paying attention to these, you can avoid losing money unnecessarily. Remember, you're the boss of your own money. Don't let the banks decide what's best for you. Take charge and make choices that will help you reach your money dreams. It's like steering your own ship. You get to decide where you want to go. I recommend you watch the next video in our series. Don't hesitate to share this video, subscribe to our channel, and share your thoughts in the comments section. Thanks for watching.